It's appropriate to start our discussion of sources of short-term financing by addressing trade credit. Approximately 40% of short-term financing is in the form of accounts payable or trade credit. This is the credit that arises when vendors make sales on credit. So from the buyer's perspective, this is an account payable. From the seller's perspective, this is an account receivable. We're sitting in the place of the buyer right now. The accounts payable are a spontaneous source of funds. And by spontaneous source of funds, what we mean simply is that as our firm gets bigger, as we purchase more goods, accounts payable is going to spontaneously go up if we're using credit. If we are having fewer purchases, let's say we have a seasonal business and during the spring we have fewer purchases and around Christmas we have more, we're going to see accounts payable decline spontaneously. So as the business grows, accounts payable expand. As the business contracts, accounts payable decline. Now the amount of payables or the period over which these payments are made varies from firm to firm. Normally trade credit might be extended from 30 to 60 days. And firms, in fact, manage this payable by, in many cases, trying to extend the amount of time that they have to pay. And the reason is this may be a relatively inexpensive form of borrowing, particularly if the vendor isn't charging interest on the payable. So if you're able to borrow at 0% interest, you obviously want to stretch out the payment period as long as you can. Having said that, there is some point at which the trying to extend that period of time becomes unacceptably long, and suppliers may be alienated and they might cease to grant credit at all. Likewise, if the firm is unusually slow in repaying its payables and paying off its payables, that can lead to a diminished credit rating. Now, for most firms, a major determinant of when the firm makes payments is whether or not there is a cash discount that's offered. So let's look at what we mean by a cash discount. Okay, a cash discount allows for a reduction in the payment amount if the payment is made within some specific period of time. So as an example, and this is an example that's given in the text as well, terms of 210 net 30 for a cash discount mean that the 2%, the 2 of the 210, is a 2% reduction in the amount that's remitted if payment is made within 10 days. So the 2 is 2%, the 10 is 10 days, but if to the extent that we don't make a payment within 10 days, everything else is due within 30 days without a discount. So the full amount is due within 30 days. So that it's referred to here as net because we could make a payment on some portion of our bill but not pay it all. The rest of it has to be paid within 30 days. Clean up for just a moment, and we'll talk about what the cost is of failing to take a discount. We can give a formula here for the cost of failing to take a discount, and that is, we've really got two pieces. Notice there's a multiplication sign out here. The first part is the discount percent, the 2% in this case, that we are able to take, divided by 1 minus the discount percent, which again here is also 2%. We put a little percent on to make sure it's clear, and that amount is multiplied by, in the bottom piece of this formula, 360 divided by the final due date. In this case, our final due date was net 30 minus the discount period, and our discount period was 10 days. So if we plug all of that in and did the math, we would find that the cost of failing to take the discount in this case is 36.72%. Now what that means is, if we want to wait until the 30-day mark rather than paying by the 10-day mark, in order to get that extra 20 days that we can keep our cash without making our payment, for that 20 days we're having to pay an extra 2%. That equates to 36% interest rate. So for most companies, that's going to be an awfully high interest rate to pay. The firm would be much happier to borrow from the bank or borrow from some other source in order to make payments on this within 10 days. Why is the firm offering terms that are this nice? Well, the reason that the supplier might be giving terms like 210 net 30 is they have some fears that if they wait very long to collect, they won't be able to collect at all. So they are looking at a company that they have some concerns about their credit worthiness. They don't want to be in the business of lending money to those firms. They really just want to use trade credit to facilitate making sales and to smooth the process. They don't want to be the principal means of finance for the buying company. So terms like this are not unusual. Now let's look at a term that's referred to as the net credit position. And we've got a lot of things popping up here at once. Let's focus on the first piece here. The net credit position is basically the difference between accounts receivable. So the difference between accounts receivable and accounts payable. Remember, our accounts receivable are an asset and accounts payable are a liability. Our receivables are generated when we make sales to our customers. The payables are generated when we make purchases from as our supplier's customer. So if we have more accounts receivable than accounts payable, we essentially are providing more credit to others than we are getting ourselves. So if there's a positive net credit position, that means we're basically a supplier on average of credit. If we have a negative position, that means that we are on the whole a user of credit. So, and that's what's described right here. If it's positive if accounts receivable is greater than accounts payable, and vice versa. Now, large firms more often are providers of credit. In other words, they tend to have more receivables than they have payables. Small firms are usually in the opposite position. The reason for this is large firms have other sources that they can raise money, and so they can raise money more cheaply perhaps from a bank than they can through their payables that they are generating, that are spontaneously being generated. And so they'd prefer to borrow, given lower borrowing costs, they'd prefer to borrow elsewhere and not carry large payables, and then they pass through this credit that they're able to obtain from a bank. They pass that through to smaller firms, essentially extending credit themselves to small firms. So the bank's lending to the large firm is lending to the small firm, in essence. So all of that's really the total of the discussion of trade credit. And in very brief summary, Companies spontaneously generate trade credit because they're making purchases of supplies. Large companies are more likely to extend credit to small companies. They nevertheless want to be careful that they don't become the principal source of financing, or that the purchaser become overly dependent upon them and take on all that risk, and therefore they have mechanisms by offering trade credit terms like 210 net 30 to try to induce those small firms to nevertheless pay off those payables as soon as they can, and to penalize them if they're not paying them off by charging relatively high interest rates through the use of a discount that is being passed up by the firm, by the small company.